Doy la bienvenida nuevamente a esta presentación de Basilea III, el nuevo marco regulador del riesgo. Para esta presentación nos va a acompañar el profesor Morton Glantz, quien nos mostrará cómo implementar nuevas recomendaciones en la medición del riesgo de mercado, crédito, operacional y de liquidez. También nos acompaña Luis Enrique Villegas, presidente de Software Shop, quien hará una presentación del profesor Glantz, hablará de la Convención Latinoamericana de Gestión de Riesgo y apoyará en la sesión de preguntas y respuestas. Les recuerdo a nuestros asistentes que esta presentación será en inglés, pero que Luis Enrique va a estar acompañándonos vía chat. Para cualquier inquietud que ustedes tengan, la pueden hacer en español o preguntas, y él con mucho gusto nos hará la traducción para el profesor. En el chat van a poder encontrar a Rocío Forero, que nos acompaña el día de hoy como monitora. A ella también podrán contactar si tienen alguna inquietud o tienen algún problema durante la presentación con la conexión o problemas de audio. A ella la pueden contactar en el chat, les recuerdo, Rocío Forero, y ella les dará el reporte que todos ustedes requieran. La presentación durará 1 hora aproximadamente, y al finalizar tendremos la sesión para las preguntas. Igual durante la presentación ustedes nos van a poder enviar vía chat las inquietudes, y al finalizar las diremos al profesor Glantz para que él pueda contestar las inquietudes de todos nuestros asistentes. Antes de iniciar, pido a algunas personas que nos confirmen vía chat que están escuchando correctamente. También podemos aprovechar para que nos digan en qué país se encuentran y de qué empresa nos están acompañando. Así aprovechamos para conocer un poco más acerca de los asistentes el día de hoy. Al finalizar esta prueba de audio daremos inicio con la presentación. Así que los invito a algunos de nuestros asistentes para que nos confirmen el buen audio por el chat para dar continuidad a esta presentación. Ok, el profesor Iván Chardón también nos está acompañando el día de hoy, nos está también confirmando el buen audio. Muchas gracias, Iván, por acompañarnos el día de hoy. Luis Enrique Hernández también nos está confirmando el buen audio. Me gustaría que aprovecháramos la confirmación del audio para que nos dijeran en qué país se encuentran y la empresa donde laboran actualmente. Si de pronto hay alguna empresa que nos está escuchando por el departamento, o sea, más personas del mismo departamento, también nos gustaría que nos comentaran, pues así nos hacemos una idea más global del perfil y de todos los asistentes del día de hoy. Entonces los invito entonces para que me confirmen vía chat. Arecio Morán también nos está saludando desde Venezuela. Gracias, Arecio, por acompañarnos el día de hoy. Andrés Martínez dice que está en la Universidad Nacional de Colombia en Bogotá y el audio está correcto. Gracias, Andrés, por acompañarnos. Bueno, Iván Chardones está en Puerto Rico, nos acompaña de Quality Risk Management. Gracias, Iván. José Rico en Bogotá, profesionales de bolsa, área de riesgo. También nos acompaña Kelly Melisa Ballesteros, dice que escucha perfectamente. Está en Colombia y pertenece a la compañía Valores Bancolombia. Ok, muchas gracias a estas personas que nos están confirmando el buen audio. Wilmore Chávez, escucha perfecto, está desde Honduras, desde la empresa ODEF Financiera S.A., gerente de sistemas. José Acosta está desde Caracas, Venezuela, de la UCAP. Camilo Bossi también nos acompaña el día de hoy. Alex Araya desde Costa Rica, Dirección de Riesgo de Crédito. Rocío, bueno, Rocío nos está saludando, nos dice que Alex Guarachi nos saluda desde Bolivia, Ubebe. Muchas gracias, Alex, por acompañarnos. Bueno, Bancolombia nos acompañan varias personas del área de auditoría. Carla Cofiño nos acompaña desde Venezuela, trabaja en Banesco, el Banco Universal, modelos y metodología de riesgo. Ok, bueno, muchas gracias a todas estas personas que nos confirmaron el audio vía chat. Les recuerdo que durante la presentación, igual ustedes nos van a poder enviar cualquier inquietud que tengan. La pueden hacer la pregunta tanto en inglés como en español, que Luis Enrique nos estará ayudando con el profesor Glantz para traducir las preguntas que sean necesarias. Vamos a dar entonces inicio con la presentación, Basilea III, el nuevo marco regulador del riesgo, y los dejo con Luis Enrique Villegas, que nos hará la presentación del profesor Morton Glantz. Bienvenidos.
Buenos días a todos los asistentes. Esta conferencia del profesor Morton Glantz es parte de un ciclo de presentaciones vía web que estamos haciendo previos a la Convención Latinoamericana de Gestión de Riesgo que vamos a tener en Cartagena del 15 al 20 de abril. Vamos a estar haciendo algunas presentaciones con los instructores y con los conferencistas que nos van a acompañar para hacer como un prólogo a los temas de los cuales se va a hablar y se va a discutir durante la convención. En esta presentación, el profesor Glantz nos estará hablando sobre Basilea III y sobre riesgo de crédito. Ha tenido una muy buena acogida, recibimos cerca de 500 inscripciones al evento. Nuestro equipo de telemercadeo logró confirmar 200 personas por teléfono y tenemos otras cerca de 300 personas que no alcanzamos a confirmar, pero que de todas maneras se les envió vía email la información para que se conectaran. Tenemos personas de toda Latinoamérica, tenemos bancos centrales, tenemos superintendencias, tenemos ministerios, tenemos empresas de bancos, compañías de seguros, tenemos consultores, entonces tenemos una audiencia muy nutrida. El profesor Morton Glantz se ha desempeñado en varios bancos de los principales de Estados Unidos con altos cargos. Su último como ejecutivo senior del JP Morgan. Es autor de varios libros. Los más conocidos en nuestro medio está el Banker's Handbook on Credit Risk, es un librito rojo que muchos banqueros conocen, y otro libro que es el de Ingeniería de Riesgo de Crédito. Adicionalmente, el profesor Glantz es un experto en Basilea III. Él dice que casi que ese es su apellido. Conoce perfectamente la reglamentación y apoya a compañías del sector financiero en su implementación y en el desarrollo de modelos. Esta conferencia va a ser en inglés. Vamos a tener el apoyo para la traducción de preguntas al final. Y además de eso, los textos están escritos en inglés para si de pronto alguien no alcanza a entender bien por el audio, puede leer los textos. Entonces, los voy a dejar con el profesor Glantz. Professor Glantz, I already made an introduction about yourself, about your experience as a credit risk expert and a Basel III expert, and your experience in the financial industry in the United States and as a professor. We have a very numerous audience from all of Latin America. We have people from central banks, we have people from regulators, associations, banking associations. We have several banks, and we have insurance companies, as well as consultants from the region. Antes de iniciar, también quería comentarle a nuestros participantes que al final haremos una breve descripción sobre la convención. Para quienes estén interesados, les voy a hablar sobre cuántos conferencistas tenemos, qué tipo de conferencias va a haber, qué tipo de industrias van a estar presentes, sobre el CRM, la certificación en administración de riesgos, cuánto dura, cómo es el examen y eso. Entonces, para que por favor quienes estén interesados al final de la presentación esperen un momento mientras les hago esa presentación. Okay, Professor Glantz, you may continue, you may start.
Oh, okay. I'm very pleased to be here, and I'm so happy so many people are tuning in. I just want to say a few words before I start. Number one is the fact that my 8th book, Multi-Asset Risk Modeling, will be out this year, published by Elsevier, and it will cover many of the issues that Basel III is proposing, and I welcome people to look at the Amazon pre-order advertisement of the book, and good reading. Okay, so I'll start the lecture. First of all, we are going to focus on credit and operating risk with respect to Basel III. The most important issue to remember is that Basel III is not finished yet. European banks are arguing many of the points that are being proposed by Basel III, particularly the capital allocation issues, and we'll be considering those. But what is not negotiable, what is not going to be challenged, is the analytics that banks have used.
Excuse me, Professor Glantz.
Yeah.
Could you speak a little bit closer to your microphone? Some people are telling us that the volume is very low.
How's this now?
Oh, it's much better. Thank you.
Oh, okay. So let me just rephrase myself here. Some of the components of Basel III, which I'll go over, particularly in the 9 breakthroughs over Basel II, are being challenged. Some of them are European banks who are disturbed about the implementation issues in Basel III, the capital allocation, the time frame, and so forth and so on. So Basel III, in many regards, is still open to negotiation in not major issues but minor issues. However, what is not negotiable, what is not going to be compromised, are the analytics, the stress testing, the issues of systemic risk that the analytics bring to bank, the issues of sustainability management in the event of additional crisis. This is not negotiable. And what is important is to remember that banks have never used the tools that were available, like stochastic optimization, simulation, real options, the ability to understand systemic risk. These issues caused a lot of problems in the world debt crisis, and Basel is very concerned that the technology of banks, from regional banks down to community banks, are improved so that when the next debt crisis comes, that the regulators are going to rest assured that it's an exogenous problem, not an internal bank problem caused by the mismanagement of the analytics. So with that in mind, I'm going to go through each of the breakthroughs of Basel III, present an overview of Basel III, but I'm going to bring you into some of the areas of systemic risk that deals with extreme value, conditional value at risk, and so forth that banks are going to have to look at. So here we go. The 2 big issues in the Basel III framework are limiting the likeliness of failure in individual institutions, meaning that banks have to hone up to the rules of good banking and not be callous anymore in their lending activities. And number 2, be prepared for a systemic crisis that, rather than happening 1 every 1,000 years, seems to be happening rather regularly. So the Basel III Capital Accords deal with 9 breakthroughs. 9 breakthroughs represent a very substantial change from Basel II, whereas Basel II had only a moderate change from Basel I. So we're dealing with a very big move, a very big leap forward. Now, in a nutshell, these are the breakthroughs. I'm going to be focusing on the last one more than the other ones. The capital equation, that is the numerator of the capital equation, is going to be different. There's a trading book loophole that will be resolved. The calibration of the capital ratios are going to be seen. The dividend policy of banks are going to be reviewed by regulators very carefully. There's a new leverage ratio that deals with total assets as well as risk-adjusted assets. There's an issue of a capital allocation with systemically important financial institutions. There's going to be, or perhaps, a surcharge on the institutions that are too big to fail. A counter-cyclical capital charge, meaning that in times of boom, these surcharges will apply, because following boom comes bust. And the regulators want to be sure that reserves are put aside in boom periods to take care of bust periods. There's a big derivative issues that we will momentarily talk about. And of course, the issue that is on everyone's plate are the internal models that need to be addressed that move more towards extreme value, conditional value at risk, and not simply a value at risk approach, which will leave only a 99% probability that you've covered enough that you have enough capital to cover your exposure. Now, basically, this is what we have. Basel III, 4.5 minimum. Common equity carries the ball here. Tier 1 capital plays a secondary role. It's common equity that's key. Common equity with a conservation buffer of 2.5. The 2.5 means an additional capital allocation which recognizes the probabilities that down the road, maybe sooner than later, is another macroeconomic crisis. So in order to keep banks healthy during macroeconomic and industry shock, a minimum of 7% common equity is required. Now again, there are a number of bankers out there who are arguing against some of this, and the issue is not at rest at this point. We have to wait and see whether final compliance will hold at the 7%. But many banks are very upset because they feel that they have to sell assets, get rid of some good quality deals in order to sustain the capital allocation. Tier 1 comes in over the capital equity. So common equity and Tier 1 requires 6% as opposed to 4%, plus a 2.5 required conservation buffer, and total capital now 10.5 as opposed to 8%. So there's been a big change in the capital allocations in anticipation of a future economic shock. Now I'm going to go through very quickly the key breakthroughs. The first breakthrough has to do with the recognition that Basel II was confusing to many bankers in terms of capital allocation, because we had all different definitions of capital. Tier 1 capital, innovative Tier 1 capital, upper and lower Tier 2 capital, Tier 3 capital, and at the end of the day, nobody knew what capital was. So complexity was at the root of some of the problems, not all the problems. Now, we're in a different focus. Basel III said, forget about all this. We need a clear definition of capital above all else. A definition that everyone understands. And this is common equity. Common equity represents the highest quality component of the capital base. It's where we write our loans down. It's clearly recognized as retained earnings and common stock and so forth. So the numerator has been homogenized. And there's no strict definitions of redefined capital 1, capital 2, Tier 1, Tier 2 capital. And Tier 1, I think you can find this on the internet. I'm not going to go over Tier 1 capital detail. We don't have that kind of time. But Tier 1 capital consists mostly of subordinated debt with some strong requirements against the Tier 1 capital. And Tier 2 capital provides absorption as well. Tier 3 capital has been eliminated. Now, here's the issue. The risk-adjusted assets are still in place, and these deal with weights. However, one of the breakthroughs, and I'm going to go over that very soon, is that risk-adjusted assets is a rather misleading issue when it comes to capital allocation, because what is seen here are buildings, other assets, not just risk-adjusted assets. And if you put risk-adjusted assets in the numerator, and the capital required in the, risk-adjusted asset in the denominator, while in the numerator carries capital, you can have a small denominator. And banks would feel that they are in compliance with capital allocation. Basel III recognized that, and I'll show you a chart in a minute. But what you have to keep in mind, what is needed is a bigger denominator, because a bigger denominator has not only the risk-adjusted assets, but total assets. Total assets are in there. So the capital allocation is affected. And now banks realize that perhaps in the older days, they didn't put enough capital in. And this is a very important breakthrough. We'll go over that in terms of visualizing a chart. So aside from the accusation that some banks were understating the risk-adjusted assets, come Basel III, that you can't do that anymore. Because forget about risk-adjusted assets as just the only capital ratio. It's total assets. And what are you going to do? You can't hide behind that. Okay, this is the chart I was looking at. As you can see, the denominator, enhanced risk coverage, risk-adjusted total asset, top 50 bank. Okay, well, I got a better chart here. And this is coming up in a few minutes. Let me just go back a minute. The chart I'm going to show you is that the risk-adjusted assets grew smaller than total assets, which really went up, and during the debt crisis, understated the capital allocation. All right. Let me go to
if you can please go back to getting closer to the microphone.
Okay, how's that?
Okay, yeah, better. Thank you.
I'm gonna let me hold it. Let me hold it. Is it better now? Can you hear me better?
Yes, yes.
All right. Okay. So the bottom line is the Basel Committee introduced a backstop simple leverage ratio requiring minimum capital ratio equal capital to total assets without the risk rates. Okay, now let's look at the second breakthrough. Counterparty risk. Counterparty risk was, in Basel II, only recognized in terms of defaults. And we know that that didn't work. We need to look at credit migrations, mark-to-market losses as well. Because during the crisis, mark-to-market losses were astronomical. And this was not recognized, and the capital allocations fell apart. And we know about the AIG story, which we don't have time to talk about, but the AIG story is famous because of the toxic credit derivatives they put up there. So the capital ratios now deal with quality. It's very, very important. Okay, now, here's the third breakthrough. The third breakthrough is a conservation buffer. Now, what that means is that everybody recognizes that the capital allocation associated with equity and Tier 1 in general is not enough. Under a normality assumption, even at the 99% confidence interval, not enough. Because economic crises don't happen once every 20 years, once every 40 years anymore, once every 90 years. Economic crisis happens frequently. So in anticipation of this potential, the Basel III has proposed a 2.5 conservation buffer meaning that banks have to throw in an additional 2.5 to prepare for the next macroeconomic crisis. And of course, there's a bone of contention with banks that are not too pleased with having to put up capital when one chance in a million will happen that will cause an erosion of their base. But we saw Sandy, we saw 1987, and I don't have to tell you about the crises that occurred. So we have the calibration of the capital ratio, which is the third breakthrough. Okay, here it is again. Another important breakthrough is dividend policies that banks need to consider. And the dividend policies are tied to the capital conservation principle. In other words, here's how it's going to work. Again, there's controversy here. If the banks in question are not putting forth an additional 2.5 in conservation capital, they may not be able to pay as much dividends. Or if they pay the dividends, the regulators, when they examine the capital allocation of these banks, finding the dividends, are going to cite the banks for being too liberal. So the dividend policy of banks are going to have to be rethought. No more carte blanche dividends until the proper capital allocation is covered. Again, let me just do a quick review. Number one, the insurance that we have total assets as not just risk-adjusted assets, total assets is the denominator of the capital ratio. And number two, the conservation buffer 2.5 is addressed. Okay. Now the implementation is here. I'm not too sure if these still hold. I know the European banks are questioning a lot of the issues in Basel III, and this is not just European banks. So this may or may be adjusted, but right now the phase-in is 2016 for the conservation buffer. Okay, now let me quote. We witnessed during the crisis, practice by banks to continue making payments, these are dividends, even as their financial condition and capital levels deteriorated. This practice, in effect, puts the interest of the recipients of these payments above those of the positives, and this is simply not acceptable. This is coming right out of the Bank for International Settlements and the Basel Committee. So banks are going to have to really defend their dividend policy as a major effect of Basel III as it stands right now. Okay, let me just move a bit forward here. The leverage ratio. There's the leverage ratio again, and this is the comparison. This is the chart I was looking for, everybody. The risk-weighted and total assets of top banks. Now, at the top curve, the blue curve, you see a greater increase in total assets as opposed to a very small or level change in risk-adjusted assets. Again, the capital ratio is going to bring in total assets as the major driving force of the calculation, which means that banks are going to have to put more capital through because they can't ignore building, equipment, subsidiaries, investments, and the like. Okay, now, the countercyclical capital change breakthrough. Let's talk about this. This is an important one. Basel III, knows countercyclical capital buffer. Let's see what this really means in plain language. You all know that during the 90s we had a tremendous boom, and then we got hit with an internet crisis, and we had another little boom with the housing going through the roof. Everybody was lending. Money was hot. Banks kept up carte blanche lending, as we know, and everyone smiled. But what people forgot was boom goes to bust. Go back to history. We see this often. Maybe not as serious as the last macroeconomic crisis, but sure enough, we have recessions after booms. So the jury is out on this. However, the initial proposal was there's going to be a countercyclical buffer associated with the areas. It could be different in Colombia. It could be different in Brazil. It could be different in the UK, in the US. It depends on the boom, and it depends on the regulators. But it could range from 0 to 2.5 of common equity in a boom period to be set aside above the 2.5 conservation buffer in the event the boom turns to bust. So the capital allocation is now inclusive of a countercyclical capital buffer. This is another breakthrough. Okay. Systemically important financial institution breakthrough, which means that the big banks out there, J.P. Morgan Chase, UBS, the banks that are too big to fail, the banks that would carry the crisis beyond their own institution into the realm of the public community, is going to be charged an additional buffer because they were too important to fail. And you can believe some of those banks are not too happy about this. There's going to be more publications on this issue, and I believe that the jury is still out. I'm not sure, but I believe the jury is still out on that. Okay, microprudential, and this is where we're going to do a little bit of focus. Microprudential means better capture systemic risk and tail events in the bank's own risk management framework, including a thorough risk modeling, stress testing, and scenario analysis. During this hour, I'm going to demonstrate some of the issues that we are talking about under microscope, including a breakdown of the value at risk model, entry, conditional value at risk, entry, simulations, portfolio optimization, real options, data mining, and the issues and technologies banks never even dreamt about in years past. Let's see what Basel has to say about this. I'm now downloaded from Basel, and Basel is talking about this when they put forth the proposal of Basel III. The Lehman Brothers failure, low capital charge when over-the-counter derivatives fail to capture systemic risk associated with interconnectedness and potential domino effect of these markets. Higher capital requirements for bilateral over-the-counter derivatives will increase incentive to use exchanges. What Basel is saying is they're not too happy with the derivative market, which is over-the-counter derivative trading as it appears today. They would like to see a market for derivatives. And this is still the jury is out. Now, here's the main point of my argument. This is where the jury is not out. This means compliance, and the regulators are going to be on top of this. And I'm going to quote from the Basel Committee, and I think I might even read the slides, because the slides are quotes from the proponents of the Basel Committee, the Bank for National Settlements. Quote, "The crisis heightened the weaknesses of banks' advanced risk management based on risk models. Stop. What was the problem here? The problem was that many of these models got to be so complicated that they missed the forest through the trees. They were great during periods of normal economic downturns. They were great in periods of what we see as the world at large. But they fail in depressions. They fail in crisis because we're not dealing with a normal assumption issue here. We're dealing with stress at a 99.999% probability, meaning that the value at risk models, whoops, let me go back. Sorry about that. The value at risk models and the other technologies that were supposed to be advanced fell apart. And here's a quote from Basel. The value at risk calculations transformed complex and multifaceted risk position and has potentially huge nominal amounts into a single compressed risk factor. Now, what this means is very, very simple. Going forward, we put a portfolio together. Yeah, we go to Moody's, we go to S&P. It's very important to get models like that, but it's more important for internal models to be developed. Portfolio models, and I'll show you one, that may reflect how we feel as a single bank about the volatility of our industries that we're capturing in the portfolio. We need to develop risk rating systems that reflect not what Moody thinks of our credits, of our portfolio, but our due diligence analysis where we can quantify what a AAA is through our cash flow analysis, our debt capacity analysis, our due diligence of our client, our knowledge of the markets. This is the credit that brings the credit analysis that brings the portfolio into compliance with a Basel III. So, and again, I'm going to go over this in model form. I'm going to develop some of the models as door openers. But when the regulators come in to inspect the bank's capital, they're going to be looking at the portfolio. And not just credit risk, but operational risk, liquidity risk, legal risk, market risk. And they're going to be interested in the due diligence that the bankers themselves performed internally, the knowledge that the bankers have internally, rather than looking at a black box, looking at the regulators, and we all know what happened to the regulators, I must add, in some of the ratings that they gave that completely lost credibility. So this is very important. Now, here we go. BIS, quote, during the crisis, the value at risk model severely underestimated the tail events and the high loss correlation under systemic stress. Value at risk model warehouse for assessing risk in normal markets, but it did not fare well in extreme stress situations. Systemic events occur far more frequently, and the losses incurred during such events have been far heavier than value at risk estimates have implied. And here we have an example of a value at risk carrying us to 2.33 standard deviations under our normal distribution. Banks were using normal distributions, and that is the way things broke. No such thing as a normal distribution in a lending portfolio. The volatilities of each industry, of each client, determine the shape of the distribution, and most of them are beta distributions. As a matter of fact, a AAA has a 0 standard deviation, as opposed to a B rated company that standard deviation is far beyond 0. So we're dealing with not 2.33 standard deviations under a VAR assumption. We're dealing with 99.999999 extreme value calculation. So we know the models that, like, for example, the simulator, real option valuation, they have in their model base extreme value, and this is very, very important, and they're not the only ones. Okay, so in the real world, false sigma events do occur, and they occur more than once every 125 years, and that's where it stands right now. Okay, now I'm going over the modeling, but very, very important. I want reinforcement in what I say, because it's very critical that you don't hear this from me, because I know I'm a professor, I know I wrote 8 books, but that doesn't add up to much. The geniuses that are doing this work are in the Basel Committee and the Bank for National Settlement. And I want to remind you of something. I'm going to bring the principles for the management of credit risk, the Basel Committee on Banking Supervision. This was published before the debt crisis. And I want everybody to look at these principles and ask yourself, what happened in the debt crisis that could have been avoided? And it's not the banks that are at fault 100%, not at all. I'm blaming the regulators, because where were the regulators when the debt crisis was accumulating and the principles of sound credit risk were already published in the repertoire of lending? Okay, here's one, principle 4. Banks must operate under sound, well-defined credit granting criteria. The criteria should include a thorough understanding of the borrower or counterparty, as well as the purpose and structure of the credit and the source of repayment. Let's stop on that. We don't go and look at Moody's for this. We don't run simple due diligence. In order to understand the borrower, we have to know the industry that the borrower works for. We have to know the counterparty risk. We have to run the modeling under our normal due diligence process, not deterministic projections where we just look at most likely and stress. We need projections that are stochastic, that enable the banker who understands not just the most likely, but the extreme stress, to be able to incorporate the banker's knowledge into the computer model we call Excel, maybe with a risk simulator on top of this, to be able to reflect their knowledge so that they come up with a credit decision that's not just most likely or a simple stress. So principle 4, simulation, stochastic optimization, real options, data mining, is in compliance with the Basel Committee. There's the proof right there. It means that the due diligence of the banker is the banker's responsibility. Let's take a look at principle 6. Banks should have a clearly established process in place for approving new credits, as well as the extension of existing credits. The banks that bellied up, that went out of business during the debt crisis, they had no back office. They had no way of knowing what their portfolio risk was. They had absolutely no understanding what the Sharpe ratio was. This has to change. Credit, I know, and we all know, is a little bit tight right now, but that's very temporary. When the debt crisis is over, a few years from now, maybe even a few months from now, banks need to be prepared to eliminate operational risk, back office risk, and bank policy to establish the process of defining what clear credits are. This is the responsibility of the board of directors and senior management as well. Principle 9, banks must have in place a system for monitoring the condition of individual credits, including determining the adequacy of provision and reserves. Banks should develop and utilize internal risk rating system in managing credit risk. All right, let me stop on that one. Principle 10, we know there's been a change in the capital allocation, Basel III. There's going to be, of course, an inspection as to whether there's compliance or not. Basel III is not, at the end of the day now, it's going to change, and maybe it'll be a little more liberal, but what is not going to be liberal is Principle 9. That is firmly cemented in the rocks. And that means that due diligence by the bankers themselves, and it means utilizing internal risk rating systems, are going to be crucial here. Because these internal risk rating systems are going to be generated by the components of due diligence cash flow, debt capacity, asset quality, contingencies, valuation, management, industry risk, documentation, collateral, guarantees, portfolio management. That's what a banker needs to know today to be in compliance. And believe you me, I'll put my reputation on the line here. When the regulators go to the banks, and I'm not just talking about the U.S., and they see that the proper due diligence are within the credit files, they're going to automatically, well, I can't say automatically, they're going to assume to a high degree that the bank is mining the store, that the capital allocation is mining the store. But if they go to a bank, they see no improvement from pre-debt crisis to post-debt crisis in the due diligence process of banks, they're going to come back with very strict capital requirements. And these are the regulators talking, not me. Principle 11, banks must have information system and analytical techniques that enable management to measure the credit risk inherent in all on and off balance sheet activities. I think that speaks for itself. This is global exposure systems, data mining, data warehousing, and there are vendors out there, I won't get into specifics, that offer this. Principle 12, now this is the one that I'm talking about, that I want to link to Basel III. Banks should have taken into consideration potential future changes in economic conditions when assessing individual credit in their credit portfolio, and should assess their credit risk exposure under stressful conditions. This is my license to get into Excel, which I'm going to do in about 3 minutes from now. But please remember that Basel III came into existence because of the shocks associated with economic conditions. Basel III is in place because banks forgot about the possibility of a collapse in economic conditions and assumed only normalcy. This cannot happen again, and this will not happen again. And banks must have a system in place for managing problem credits and various other workouts situations. This is my specialty. And finally, banks must establish a system of independent ongoing assessments of the bank's credit risk management process, and the results of such review should be communicated directly to the board of directors and senior management. Okay, in conclusion with my slideshow, before I go into my Excel and take my questions, what is critical here is that the credit policy of the bank, is going to be seen by the supervisors, by the regulators. And if they see that the bank is mining the store, Basel III will come as a secondary issue. Because they're not going to worry too much about a bank like that collapsing. They're not going to worry when they see a problem loan area that's up to snuff, that is professionally run. And believe me, the regulators are going to be ensuring that the banks will be in compliance with the major issues, not all issues, but the major issues of Basel III. Okay, I'm going to close this out. I'm going to demonstrate the ninth breakthrough, stress testing, and the new approach that we have to new technology, namely simulations, stochastic optimization, understand our client to a high degree. Okay? Is everybody still with me? Okay. Can you see this?
We got the asset allocation optimization model on the screen.
Okay. I'm going to show you asset allocation optimization model. Again, this is very simplistic, but we're going to see a before and after. The first issue in a portfolio, a bank portfolio, and remember, the capital allocation of a bank in terms of credit risk is associated with a portfolio. If the portfolio is in balance, namely the covariants are optimized, that we don't put all eggs in one basket in a portfolio. You all know what happened during the housing crisis when everybody was greedy for profits and just put housing loans on, more housing loans on, more construction loans on, and then we had a destruction of the banking system. A well-diversified portfolio is the best assurance that the regulators are going to pass proper judgment on the capital allocation. So senior management has broken the bank's industries down into 10 industries. The industries are associated with the annualized return. We look at risk-adjusted return on capital. I'm not sure this is capturing risk-adjusted return on capital, but we need not just profits associated with this. Now, the volatility risk is extremely important. Now, what I want to point out here is that I have set under a stochastic assumption just industry 1. We're leaving industry 2 through 10 as deterministic. Now, this is wrong because the industry 2 to 10 should be formed under stochastic conditions. I'll go through this in a minute. Let me go through my optimization. First, the allocation weights on a default is 10%, 10%, 10%, 10% all the way down. Namely, the bank's capital with respect to the loan portfolio is evenly divided before optimization as an allocation of 10% each. This is going to change because some industries are going to balance off other industries in terms of covariance risk, and there's a better mix of portfolio that will optimize the Sharpe ratio. The Sharpe ratio is the risk, the return associated with the risk. The required minimum capital is in the next column, no less than 5%, no more than 35% capital. Now, those who are familiar with optimization will recognize that these are decision variables. The return to the risk portfolio comes next. Okay, now I'm going to get involved in this in the conference a little bit more. This is not the time to really get into the nitty-gritties, but let me show you something. I'm going to open up Risk Simulator. I think Risk Simulator, there are 3 models that you can use, Crystal Ball and At Risk, but I think I'm a little biased to Risk Simulator because I'm not going to get into the detail there, but I'm going to use it and I'm biased towards it. Okay. Now, this is what we should have been doing with industry 2, 3, 4, 5, 6, 7, 8, 9, 10. First thing is that I'm going to put stress on this industry. What do we mean by stress? Well, the most likely return is 12%. However, Let me move this along. I'm sorry. Sorry about that. The highest volatility, I'm sorry, not return, is 12%. The maximum volatility, 18%, but I stressed this, this variable because the minimum is 11%. The minimum is right on top of the most likely and far beyond the maximum. So putting stress on that variable is going to force more capital into play and affect the Sharpe ratio. Okay, let me move this out of the way. And okay on that, and let's proceed. All right, here is what we're going to do. I'm going to run an optimization by first looking at my variables, and we'll see how this works. I'll set an objective. The objective is to maximize the Sharpe ratio. In other words, the return to risk ratio. We want to maximize that ratio. Next, let's set an objective of the decision. The decision, the decision variable is that we want no less than 0.05 lower boundary, no more than 0.35 upper boundary investment of the bank's capital in Industry 1. So unlike a deterministic portfolio management system that offers nothing but risk and no intuition, we now can sit together with senior management and say, let's look at our industry risk and temper the industry variables against no more than what we would accept, no less than what we would accept. These are our decision variables. And finally, we need to set a constraint. The constraint is that the portfolio no more than 100%, no less than 100%. Okay, now here we go. Let's run an optimization. All right. Optimization shows that the Sharpe ratio has changed. I think we did do this again. We have different. Whoops. Okay, I'm gonna have to re-enter this thing. Okay. Oh, this didn't work. It worked during the rehearsal, but didn't work here. Can I try this again? Let me try this again. How are we doing for time? Maybe we should have some questions first while I set this up.
Okay.
That's a question while the computer collapsed on me. One of those things.
Sure. Okay. Let me have Lisa look into the questions on the chat, so maybe you can answer those while you get the Excel back on. Just a moment. Lisa, ¿tienes preguntas en el chat que podamos ir pasando mientras arranca el Excel de nuevo? Yeah, we have one from Jose Villegas. He says, why do you assume a triangular distribution on each particular volatility risk?
Okay, this is a default. The triangular distribution is an easy one to recognize because it has a most likely, a worst case, and a best case scenario. Let me just get this back.
Tengan preguntas, las pueden enviar por el chat. Lo quieren enviar a todos los panelistas.
I'm trying to get this back. Okay, here we go. It'll come back to me. Okay, I'm going to try to run it again. The computer crashed. What do we do now? No, I can't get it up. I'd have to restart my computer. Do we have any other questions?
Because now I'm having trouble with the chat.
You're having trouble with the chat, yeah. All right. Sorry about that. It worked all the way through, but we're dealing with computers. I'll try it again.
Murphy's Law. Every demo has that problem.
What happened? I have to restart Excel. It's not going to work. Why don't we take, we can take questions now, and then I'll do the best I can to get this straightened out. I'm going to have to shut the computer down.
A question from Ivan Chardon. It says, yeah, it's going to be difficult to consider future changes in the economy. How can we handle that in Basel III?
Can you repeat that one more time, please?
Sure. He says that it's difficult to foresee or consider future changes in the economy. So how can that be handled in Basel III?
All right, well, this is an exogenous issue, meaning that the local regulators know that there's going to be some, could be issues in the economy in Colombia. And when the bank is reviewed for capital allocation, this is going to be taken into consideration. However, we need to recognize that there's a conservation buffer and these so-called provisions to insulate the bank for any unseen catastrophe is the issue of the day. as long as there has been a reasonable attempt to do the proper analysis with regard to the risk, which are operational risk, liquidity risk, credit risk, and so forth, and the bank is proving that there is the proper due diligence, there's not going to be the heavy-handedness in the capital allocation as it would be to a bank, say in Colombia or in Brazil, that is sloppy, very callous in the way they put the risk profile together. I think it's going to be on an individual by individual basis.
Okay. I have a question from Venezuela, Vanesco Carla Cofinho. She is asking if we wanted to indicate on the balance sheet of a bank which would be the most impacted accounts by Basilea III. Basel III, I mean.
Okay. The regulator is going to be looking at the reserves that you put in the portfolio itself. What this means is that the portfolio, if the portfolio is, and I have a chart, but it's going to take me time to hunt for the chart. If the individual loans are high risk, and you should look at Moody's KMV charts for this. It's not that important if the individual loans are at high risk. However, if the portfolio is well diversified, and on balance, when you combine the covariances of all the loans that are in the portfolio, so that the efficient frontier indicates that on balance, the portfolio is very close to where the X and Y axis meet at the beginning of the efficient frontier. The capital allocation is going to be rather light, will not be severely criticized by the regulators. But if you have all your eggs in one basket, like we did in the housing crisis, where there's not a spread under the efficient frontier, one collapse in that market will send the whole bank into turmoil. That's when the capital allocation is going to be really challenged. So a well-diversified portfolio, where if you go to the Moody's KMV chart, I have it here on my computer somewhere, you have no worries about the capital allocation. Even though an individual loan may have a high capital risk, on balance, the portfolio has very low chance of being in destruction under a macroeconomic situation. I'm trying to open my files here.
I think let's don't worry about the model. We are running out of time, and I have quite a few questions. So, okay, I have one from a very important university in Venezuela, IESA. Luis Bogiano, he is asking, how can you best determine the appropriate distributions for the risk variables? And excuse me, I wasn't putting these questions in Spanish for the attendees, so let me do it for this one. El profesor de la Universidad IESA en Venezuela, Luis Bogiano, le pregunta al profesor Glantz cómo podemos determinar cuáles son las mejores distribuciones para las variables.
Okay, I think I understand the question. How do you determine the risk variables?
Exactly, okay. the appropriate risk variables.
Okay, that's a very good question, and I have an answer to that. As far as the biggest problem, and that's the credit problem. We all know that. I mean, liquidity is a problem. There's some issues with other parts of the capital allocation, but we're dealing with credit now. The credit grading system has the risk variables to it. In other words, the way the regulators are looking at this would be to develop a risk rating system that puts the proper balance on the industries. For example, an industry that is in the, say, real estate. Real estate variables are different than an industry that is in, say, manufacturing. So it is very, very important to develop risk rating systems that are specific to each industry that you have. We have those already in place. The default probabilities are the probabilities that your bank has already accumulated in a global exposure system. In other words, you've got to have a global exposure system that reflects the defaults in your bank, the industries in your bank, and sooner than later, you're going to be able to put those into a database where there's correlations between the industries that you are serving and the default frequencies that are not New York-based or not London-based, but are specific to Bogota or to any country, any city, Rio or any place else. These default probabilities are going to be reflected on an individual industry-specific risk rating system, which I have in my possession, which I developed in my career over at JP Morgan Chase and so forth and so on. And this is how it's done. So a well-diversified portfolio that's backed up with a strong risk rating system in each industry is going to be blessed by the regulators, and the capital allocation is going to be determined with a good degree of accuracy. So the answer is you've got to develop a risk rating system for each industry that you run to.
Okay. I have a question from Jose Villegas. He says, on the counter-cyclical buffer, how could Basel III determine if the 2.5% is enough for worst-case scenarios?
Okay, this is a default. I want you to remember that this is a default inclusion in the Basel III approach. It goes from 0 up. That is going to depend on your local regulators. Your local regulators are going to be the determination force behind these capital allocations to begin with. And they're going to have all this information well in hand. Don't forget, one thing we have to remember is that a bust is followed by a boom is followed by a bust. And instead of paying dividends, carte blanche, in a boom where everybody's making profits, the regulators want to make sure that the banks recognize that, hey, following the boom is going to be the bust. We need a little extra capital where the regulator is going to determine over and above that 2.5 just to keep everybody safe. So this is the jury's out on that, but it's going to be something that will be considered very seriously.
Thank you. I have a question from Olga Delgado. How can we choose appropriate macroeconomic variables to simulate an external shock on the financial system? And also, how can we choose the correct size of the shock?
Okay, let's go with statistics first. The old school of thought was a 99% confidence interval. This is value at risk. And of course, it's going to well over that 99.9995, which is extreme value. What you need to do is to go back to your loan portfolio and see how your loan portfolio measured up to the last crisis, and build your confidence interval against that. For example, if you had a well-diversified portfolio that the exposures balance themselves off in a decent covariance, you would not have to go to extreme value in the allocation of capital, because you've already shown that you're a survivor in a recession that was deep as we can possibly get. So that the initiation of the risk rating systems the global exposure systems, the due diligence in appraising individual credit analysis is going to link directly to the capital that you provide. So if you have powerful risk rating systems, I'm not talking Moody's KMV. I'm talking about internal risk rating systems that are industry specifics. You're not going to have to worry about the capital problem as much as a bank that is sloppy with this and has absolutely no modeling and tons of operational risk. I hope I answered that question.
Yeah, thanks.
If I didn't, please come back.
Okay, he will. So I have another question from Federico Rios. He works Senior Risk Manager at Scandia. And his question is, in order to optimize the relation between the risk variables, what distribution copula is the most appropriate to implement a risk model?
If you're going to use, you said distribution?
Yeah.
Okay, the distribution that is, the acceptable distribution is a beta distribution. It's a beta distribution, not a normal distribution that may be more appropriate for foreign exchange. It's a beta distribution. However, the beta distribution is driven by the standard deviation of the beta distribution. And the standard deviation of the beta distribution is driven by the risk rating system. You can't make up a beta, you can't make up a standard deviation. You have to have a bond, you have to have a rating that ties to your local environment, that ties to your loss given default, that ties to your risk rating system. So you must have a risk rating system that has obligor risk and facility risk that is created internally, not pulled from Moody's, not done anything else. Once you get that in place and you're able to define loss given default, then you can put the loss given default inside a beta distribution, a AAA with a 0 standard deviation. You know what that means. We have a beta distribution that's a millionth of an inch in diameter. And that's what we need. So you've got to have the big models: a global exposure system, a risk rating system, and a proper due diligence, loan policy and procedure administration. And you're going to have no problems with Basel III. Believe me, I'm telling you now. The regulators are not worried about banks that are, the regulators are not worried about banks that are doing their due diligence. They're worried about banks that have concentration portfolio, that have no idea, no clue how to do a credit analysis. They have no conception of liquidity risk. Operational risk is a shambles at the bank. They let other banks do their analysis for them. They stand by and just adopt other bank standards. This is what the regulators are worried about. If you show the proper direction in the approach to risk, you're not going to have any problem with your regulators. They're going to they're going to work with you no matter what country you are located in, and make sure there's a meeting of the minds with the capital allocations. I'm telling you, Basel III is fluid right now. There's a lot of challenges to Basel III, but one thing is not compromised, and that is the proper analysis, the proper due diligence within the institution itself. We saw that bad loans came about because people just ignored the proper direction in credit analysis and risk management, liquidity analysis. They weren't bankers. They were just sloppy people who wanted to make money. And I'm sorry, I have 8 books to justify my claim.
And I think we'll go with this last question. I have some more, but we really are running out of time. It says Basel III will reduce return on investment to banks. Do you think the committee will elaborate more flexible requirements?
It's going to because you're going to remember that the key ratio is not capital over risk-adjusted assets. That's pushed aside. There are two ratios now. It's capital over risk-adjusted assets and capital over total assets. And total assets mean you've got investments out there that could be in real estate, could be illiquid. That's going to be part of the capital allocation issue. And this is going to force banks to be doubly concerned about risk, because and investments that they make that could hurt them as much as the credit issues. So this is a critical thing. My best advice that I give bankers is to go to your regulators. Here we have the Federal Reserve Bank. Please be free to go to the Federal Reserve Bank and download the 5 manuals that are absolutely wonderful. And I have to say that myself, being a New Yorker, they're free, as a matter of fact. The manuals deal with the capital allocation of the banks. They deal with the portfolio of a bank, credit analysis, the audit requirements of the Federal Reserve Bank when they audit banks. There is no banker who is better equipped than the banker who has downloaded the Federal Reserve Loan Examination Manual and learns the tricks of the trade to do banking, because they anticipate what the regulators are doing by downloading that. I've traveled all over the world. My assignments are usually in Africa, in developing countries, and I tell everybody to download the Federal Reserve manuals free of charge. Read them, because you're going to be ahead of the regulators. You're going to be ahead of your money committee if you understand these requirements. They're wonderful. Hello.
Professor Glantz, thank you so much for your presentation and for your time.
Can I just add one thing? I want to just add one thing. At the conference that I'm going to be at, we're going to be doing a lot of work in simulations, stochastic optimization. We have case studies. It didn't work here, but this is, I'm not worried about it here. Feel free to come to that conference.
Thank you so much, and we really are looking forward to see you in Cartagena, where the concentration, I understand, is going to be more in engineering credit risk. Is that correct?
Yeah, I'm going to be bringing these issues out, much more so in portfolio management, credit risk than Basel III. Basel III is part of the process.
Of course. Okay.
I never talked to 500 people before.
Okay.
My ego was very high at this point.
Okay. It was great. Thank you so much. So I'm going to go on now to give some details about the conference that we're going to have in April. So excuse me, I'll continue in Spanish. And again, thanks for your presentation.
Okay, I'm going to sign off now. Thank you very much.
Okay. Bueno, terminamos con esto la presentación del profesor Glantz. Le doy las gracias por su tiempo. Él nos va a acompañar en la convención el 15 de abril en Cartagena. Va a tener una de las conferencias plenarias con algo de Basilea III, pero más énfasis en la ingeniería de riesgo de crédito. Paso a darles algunos detalles sobre la convención para aquellos que estén interesados en participar. La convención se compone de 2 etapas. Los días lunes, martes y miércoles vamos a estar en el seminario de certificación en gestión de riesgos. Este seminario concluye, pues son los 3 días de clase, y concluye el día jueves con el examen que se hace a primera hora de la mañana. Adicional al seminario de 3 días dictado por el doctor Jonathan Moon, también estamos ofreciendo un curso de fundamentación dictado por instructores en español. Tenemos cursos de fundamentación en Colombia, en Venezuela, en Lima, y vamos a tener una versión online, vía internet, vía web, parecido a este webcast que hicimos hoy, para participantes del resto de Latinoamérica. Después del CRM, del seminario de certificación, los días jueves y viernes, tenemos 4 ciclos de conferencias, algunas de ellas en simultánea, en donde las personas asisten a la conferencia que les interese de acuerdo a la industria a la que pertenezcan, y tendremos algunas conferencias plenarias. Dentro de las conferencias, 22 en total, tenemos conferencistas que vienen de Hong Kong, Arabia Saudita, Estados Unidos, Brasil, Chile, Colombia, Perú y Puerto Rico. Entre los conferencistas contamos con 4 PhDs, tenemos autores de más de 20 libros, y entre los asistentes tendremos 80 personas que se estarán certificando en administración de riesgos y 120 asistentes a las conferencias. Los asistentes vienen de 10 países de Latinoamérica. Tenemos personas de México, de Costa Rica, de Honduras, de Venezuela, de Colombia, de Perú, Chile, Ecuador, República Dominicana y de Puerto Rico. Entonces, es una oportunidad única para que compartan experiencias, establezcan relaciones con personas de muchos lugares de la región. Tendremos, por ejemplo, en los almuerzos, una distribución por temas, en mesas redondas de 10 personas, en donde cada uno de los conferencistas estará en una mesa y estarán ubicadas personas que tengan interés en el tema, en el área de experiencia de este conferencista. En este momento ya estamos distribuyendo las personas que han confirmado su asistencia en estas mesas. Luego, por ejemplo, si a alguien le interesa compartir un almuerzo con el profesor Glantz, es importante que confirme su asistencia lo más pronto posible, ya que los 20 puestos, porque son 2 almuerzos, 10 personas cada día, los 20 puestos seguramente se van a agotar rápidamente. Igualmente, por ejemplo, quienes quieran estar en un almuerzo con el Dr. Moon o con cualquiera de los otros conferencistas. Tendremos también talleres, hay talleres de riesgo de crédito, hay talleres de riesgo de liquidez, tenemos taller de derivados, y tendremos un taller muy avanzado que el Dr. Moon también quiso dictar sobre las partes más exóticas del análisis de riesgo que se pueden hacer con la tecnología de Real Options Valuation. Entonces, para aquellos usuarios de entidades financieras o consultores que ya tengan un nivel muy avanzado, les recomiendo inscribirse en ese taller. Solo hay 20 cupos para ese taller, porque es con computadores, y es un salón que no es muy grande. Entonces, también para que nos confirmen y darles el puesto en ese taller. Tendremos conferencias en el área de salud, en el área de infraestructura, conferencias para el sector real. Tenemos una conferencia del señor Luis Alberto Godoy, muy importante, sobre riesgo en commodities o bienes primarios. Esta conferencia también ha tenido un interés muy alto por parte de las empresas. Él maneja muchísimos commodities y tiene modelos de riesgo para muchísimos elementos. Recuerdo aluminio, hierro, petróleo, carbón, azúcar, bueno, una infinidad de elementos. Trabaja con muchas industrias, ayudándoles a manejar el riesgo en la compra de estos bienes. Tendremos también pues muchas conferencias del sector financiero, conferencias para el sector de minas y petróleo, conferencias específicamente en el área de precios de energía. Y también estarán acompañándonos en un ciclo de consultores, pues, algunas compañías de consultoría de la región que se han vinculado al evento, van a tener un ciclo para ellos, de tal manera que los clientes que estén interesados en asesoría o consultoría en algún punto específico pueden atender a esas conferencias y ver qué son los servicios que ofrecen estos consultores. También tendremos presentaciones de pósters por parte de investigadores de universidades de la región que están buscando retroalimentación de parte de los asistentes sobre los trabajos que están realizando. Bueno, con esto concluimos. Por favor, quienes estén interesados nos pueden escribir al correo convención@software-shop.com. Tenemos disponible un video en YouTube sobre la convención que les podemos enviar. Tenemos disponibles brochures para que lleven a sus empresas y soliciten los fondos. Tenemos PDFs y tenemos pues un grupo de asesores comerciales que los pueden guiar en las reservas del hotel, las reservas aéreas, les pueden dar información detallada sobre los requerimientos para hacer la certificación y en general detalles de la convención. Muchas gracias por acompañarnos y terminamos con esto la presentación de hoy. Disculpen, si alguien tiene alguna pregunta, lo pueden hacer ahora.
Muchas gracias a Luis y muchas gracias al profesor Glantz por habernos acompañado hoy. Completo la información que les acaba de dar Luis Enrique. Para las personas que están interesadas, vamos a estar dictando en algunos países el entrenamiento en fundamentación. Esto es muy importante para las personas que quieren participar y bueno, las personas que realmente solamente quieren capacitarse en el tema. Vamos a tener estos entrenamientos en Venezuela, Lima, México, ya tuvimos el de Colombia y también vamos a realizar uno vía web para las personas que se les dificulta ir a estos entrenamientos presencial. Así que las personas que estén interesadas en acompañarnos nos pueden contactar a través del correo electrónico que encontrarán en el chat, Rocío lo pondrá en este momento, que es entrenamientos@software-shop.com y con gusto les enviaremos más información acerca de este entrenamiento en fundamentación de riesgo. Muchas gracias a todos ustedes por acompañarnos. Si necesitan más información acerca de la convención, como lo dijo Luis, tenemos toda la información necesaria para poderlos enviar, tanto físico como por correo electrónico. De pronto entidades en Colombia que requieran de una persona, también tenemos a todos nuestros ejecutivos dispuestos a ir a visitarlos y darles más herramientas para tomar esta decisión para acompañarnos en Cartagena para el mes de abril. Muchas gracias a todos ustedes por acompañarnos. Estaban preguntando sobre la presentación del día de hoy, si van a poder tener acceso. Sí, vamos a enviarles a todas las personas asistentes el link de esta presentación, la grabación. Yo creo que a partir de mañana ya la tenemos disponible y se las haremos llegar al correo electrónico. ¿Querías agregar algo, Luis?
Hay una persona en el chat preguntando nuevamente la fecha de la convención. Es abril 15 al 19. El 15 es lunes, entonces 15, 16 y 17 es la certificación y 18 y 19 son las conferencias. Y otro detalle, las personas que compran la participación en la convención completa con el CRM, está incluido sin ningún costo el curso de fundamentación para análisis de riesgos. Y también quería añadir que mañana estaremos haciendo en Medellín el lanzamiento de la convención. El lanzamiento lo hemos venido haciendo, ya se hizo en Ecuador, en Costa Rica, en Bogotá, en Perú. Esta semana que pasó el miércoles se hizo en Cali, viene en Medellín mañana y en Caracas el próximo viernes. Las personas que nos estén escuchando en Venezuela, el próximo viernes tendremos lanzamiento de la convención, va combinada con un taller de gestión de riesgos financieros y no financieros, dictada por Brian Rojas. Pueden asistir al taller y después se va a hacer la presentación de la convención y la entrega de los brochures para quienes estén interesados.
Ok, muchas gracias. Cabe recordarles que ninguna de estas presentaciones y talleres tiene costo, así que asistan con personas de sus entidades, de sus empresas y les daremos toda la información necesaria. Muchísimas gracias a todos ustedes por acompañarnos. Los invito también a que visiten nuestra página en internet www.software-shop.com y encontrarán toda la información necesaria tanto de la convención como de los software que Software Shop distribuye a lo largo de Latinoamérica. Muchas gracias a todos ustedes por acompañarnos. Les deseamos a todos ustedes un buen día y nos veremos en una próxima oportunidad. Hasta pronto.